No, Prem. So students, we'll start with this particular compiler session that we have discussed in this context in the previous session, and now we will extend the discussion, students. Just give me 2 minutes herein. So students, now in the transfer pricing, we will be looking in the transfer pricing particular part. So topic that now we are going to discuss, students, would be on the transfer pricing. We have discussed and deliberated the non-resident taxation aspect. So therefore, we will be looking at the transfer pricing particular provision and the questions thereon. So let's look on the questions relating to the transfer pricing on the basis of the compiler. So let's start with this one, friends. So I'm just starting with transfer pricing, students, in this context. Yes, Devu. So therefore, we have done up till now the transfer pricing the non-resident taxation practicals we have done, and now today we'll start with the transfer pricing. So today one session is there. After that, in the afternoon, 2:55 at 2:55 p.m. there will be the second session. So we will try to expedite in the next 2 or 3 days, students. You will find maximum coverage from the compiler. So 2-3 days will be critical for all of you, students. I'll be doing a maximum coverage from the compiler session, and that will help us to cover maximum areas of your syllabus comprehensively. So students, the page number in our compiler, it's very behind actually. Page number 495, students. Page number 495, students. All of you will take this one. So we will be doing all the questions, and while I'll do the questions, I'll also very quickly will explain you the concept behind that question, so that parallelly even the concept get revised while we are discussing this particular question itself. Okay. So that would be the approach which I will be having it, and that is the approach that we have been adopting it in all the compiler sessions that we have done so far. So same approach, students, we are going to do it in this context. So let's start on this regard. Page 495, students. Now you all will take the first question. So students, let's start on this one then. The first particular point which you can see over here is about the applicability and non-applicability of the transfer pricing provision. Students, very quickly, I think all of you are aware. I just made this particular part. All of you just will look into this applicability of transfer pricing provision, students. Section 92.1, 92.2, and it is for specified domestic transaction. So if you see, so far as the applicability is concerned, we have got section 92.1, we also have got section 92.2, and then there is a specified domestic transaction. Now 92.1 says that any income, expenditure, loss or the allowances which is arising from an international transaction shall be determined having regard to the arm's length price. So it implies therefore that, students, that any particular expenditure, loss or allowance that is there which is arising from your international transaction. So there is what is required therefore for the applicability of transfer pricing provision under section 92.1 is the existence of an international transaction, students. Is the existence of the international transaction. That is point number 1. Apart from that, if you all will see over here, students, 92.2 talks about the cost allocation or apportionment between two or more associated enterprise shall also be made having regard to the arm's length price. So any cost allocation or apportionment between two or more associated enterprise shall also be made having regard to the ALP. So therefore, if there is two or more AE which comes together, then whatever is the cost apportionment or the allocation that take place between them, then even that will be undertaken having regard to the arm's length price. Even that will be undertaken, students, having regard to the arm's length price. And the last one, students, is about what? The specified domestic transaction. Okay, this is for the applicability part. So this covers your applicability. Now, students, if supposingly, if the transfer price is charged to the non-resident associated enterprise and subsequently the arm's length price is adopted, and the arm's length price, if adopted, results into what? Results into decrease in the total income as declared by the SSC in its ROI, decrease in the total income as declared by the SSC in its ROI, or the increase in the losses as declared by the SSC in the ROI, then in that particular case, whether you will still go ahead and adopt the arm's length price, whether you will still go ahead and adopt the arm's length price, to that the answer is no, students. In that particular case, the arm's length price has to be dropped. So if you see the question number 446 over here, what it says in question number 446, students, SS Limited, an Indian company, is engaged in manufacturing of the chemicals. 67% of shares of SS Limited are held by DS Inc. USA. So in that case, by virtue of 60% holding, both the entity becomes the associated enterprise. By virtue of the holding of 67%, can we therefore say both the entity will become an associated enterprise? And the answer is yes. So both this entity will then become an associated enterprise, students, in this case. Isn't it? So that is how it would be considered. Thereafter, if you all will see in this regard. So here, students, 67% of shares of SS Limited are held by DSINC.USA. SS Limited has borrowed $5 lakhs from DSINC. At LIBOR plus 180 basis point. Can you see that? Herein. So here the borrowing is at per LIBOR plus 180 basis point. So that is the borrowing. So my profit and loss account debit side, so Indian associated enterprise who has borrowed the money, their profit and loss account debit side is at what? LIBOR plus 180 basis point, means 1.8% plus the LIBOR rate. Whereas, students, the arm's length LIBOR rate which is prevailing, the arm's length LIBOR rate, students, which is prevailing is how much? The LIBOR rate which is prevalent at the time of borrowing is 4% for the US dollar. So it implies that if I would have purchased from outside, then it would be at 210 basis points, students. If you can see over here. So the arm's length price is at 210 basis point, whereas I have done the borrowing at 180 basis point. Therefore, it implies that my borrowing is cheaper as compared to what is the prevalent market rate, and thereby I have booked a lower amount of deduction of interest. Thereby, the profit which is reported by me is on a higher side, and I have already paid a tax on a higher side. So if I adopt the arm's length rate of 2.1 basis point, then by adopting the arm's length rate, what I will effectively will do, I will decrease my total income as against what I have reported in my return of income. Students. And that exactly is the point, students, over here. So, students, this is how the things are to be considered. The first question, I hope that this point is well taken by all of you. Any doubt, students? So you can parallelly ask me the doubt as well in this regard. Specified domestic transaction, students, I will be dealing with it a bit later. Specified domestic transaction, we will be discussing it a bit later. Now, students, compute the ALP through a range concept. Students, let's read this one out there. Before that, students, if you all will see over here, what is this range concept, students? Any clue on this one? When the range concept is applicable? When the range concept, students, is applicable, Prem. So, students, range concept for the purpose of applicability. If you look from the purpose of the applicability of the range concept, students, what exactly it is. Say, for example, students, when you have entered into the international transaction in which you have charged the transfer price. So obviously you have charged transfer price in the international transaction, isn't it? Now subsequently, students, obviously the ALP would be determined. And to determine the ALP, students, you will follow various methods. There are in all 5 methods which are there. Students, which are being there. So you will apply whatever is the most appropriate method. You will first choose what is the most appropriate method applicable to your transaction. Once the most appropriate method is being selected, thereafter that most appropriate method is what would be applied on various comparables which are being given to you. So there are comparable transactions. So whatever are the comparable information, students, which are being given, or comparable transactions. What do you mean by comparable transaction? The comparable uncontrolled transactions. So therefore you will apply your most appropriate method in those comparable uncontrolled transactions which are there with you, and on that basis you will determine the ALP. Now students, if supposingly the comparable uncontrolled transaction which is available with you is 6 or more, if the comparable uncontrolled transaction which is available with you is 6 or more, in that particular case what we will say is this, that if the comparable uncontrolled transaction, students, is 6 or more, then in that particular case what is that we will say? Then in that case you will then follow the range concept, and once you follow the range concept, on that basis, students, you will determine your ALP. How the range concept will be considered, we'll do it right now. But if the comparable size is not is less than 6, if the comparable size is less than 6, then whatever is the ALP that you have determined by applying the most appropriate method on those comparable size which is less than 6, then you will simply go with the arithmetic mean. You will go with what? The arithmetic mean, students. So you take the arithmetic mean of all the comparables which are there, of all the ALP that you have determined, applying the most appropriate method on those comparables, and you will arrive at the average. And that average is what would be considered for the purpose of your transfer pricing adjustment. But there is one point which is there, but that point I'll explain to you in that arithmetic mean question. So here in this question, let's have a look. So in this question number 449, students, Daimler Limited, an Indian company, is a subsidiary of Daimler PTA Singapore. Daimler India has sold, variation of 3%. Daimler India has sold raw material amounting to 7,000 unit at 9,200 unit. So therefore Indian AE, Indian Associated Enterprise, students, can you see that? The Indian Associated Enterprise has sold the raw material amounting to 7,000 unit at rupees 9,200 per unit. So that is a sale that has done in this regard. Now Daimler Limited has also sold similar raw material to other unrelated enterprise. So what they have also done, they have sold similar raw material to whom? To other unrelated enterprise, students. So that will give you the comparable data. The details of the comparables are provided below. Compute the arm's length price and determine whether Daimler Limited has supplied the raw material at ALP. So compute the arm's length price and determine whether Daimler Limited has supplied the raw material at ALP. The total income of Daimler Limited during the previous year 21-22 was rupees 9 lakhs. So students, and also that has been given to you is that you have to follow the cup method. In this case, also what has been given to you, students, they have told you that you have to follow the cup method, which is the most appropriate method. Now students, in this case, if you see herein, there are 2 years which are being given to you. 2 previous year data has been given to you. So there are in all around 7 comparables in this question, and there are 2 previous year data set which has been given to you. So what you will do, students, is that you will ignore this previous year 2021, 2020 and 2021. The last year data, you will ignore it. You will say, sir, why we have to ignore it? That I'll let you know a bit later. In the next question, one question is going to come. At that point of time, I'm going to know. I'll let you know why we are ignoring the last year data when the most appropriate method to determine the ALP is the cup method. I'll let you know that time. Now if you see again in this context, students, so in the range concept, students, as you all are aware, the first step that you have to do is that you have to arrange the data set, students. You have to arrange the data set on the basis of, on what basis, students, you will arrange the data set? So students, you will arrange the data set, students, in this context. In this context, students. In the ascending order. In the ascending order, students, you are going to arrange the data set. Okay, means what is ascending order? Means from less to higher. From lower amount to the higher amount, students. Okay, so from a lower amount to a higher amount, primarily, students, this is how the things has to be considered. This is how the things has to be considered, students. So therefore, now in this context, this is what first and foremost that you will do. So students, see the arranging the data set in ascending order. Once the data set has been arranged in the ascending order, students, once the data set has been arranged in the ascending order, students, thereafter, what is the next step? Once you have arranged the data set, students, in the ascending order, then in that particular case, you will take 35% of the data set. So 35% of 8, that will be the case first and the foremost. First and the foremost, students. And the second one would be the 65% of the data set, students. So 65% of 8, that is the second particular point which has been there. Okay, so 35% of 8 comes to around what? 35% of 8 is how much? On a rough note, students, over here, students, 2 point something herein. So if it is 2 point something, students, in that particular context, students, what is the situation that we will discuss? Herein, in this regard, students, we will say that you will take the next particular number, and the next particular number is 3. The next particular number is 3, students. So that is what you are going to take it across in this case. Thereafter, students, the next step is 65% of the data set. 65% of the data set, students. So you will go with the 65% of data set, students, and 65% of 8 comes to 4 point something. And if it is 4 point something, then in that particular case, it is herein. No, sir, 5 point something. 65% is 5 point something. So we will take the next number, which is 6. So the range is between 3 to 6. So your price that should have been charged should be between 3 to 6. That is to say, you should have charged the price between 9,400 to 10,330. And at what price, students? In your case, what is the price, students? It has been sold. You have sold, the price in your case is 7,000. 7,000 students. Just a second, students. The variation of 3% that you're talking about it is not relevant at this stage. Herein, you just focus on the 7,000 particular part. So on the 7,000 only, the discussion would be considered right now over here. Okay, so 7,000 is the price at which you have sold. So your sales is less. And where your sales is less, students, as you can see, in this case, whether the transfer pricing adjustment, will that be required to be made? If your sales is at 7,000 only in this case, so definitely your transfer pricing adjustment is required, because then there's an underreporting on your part. There is an underreporting, students, on your part, isn't it? And accordingly, now students, what we will do, we will take 50% of the data set. In this case, students, we will take 50% of the data set. So data set is 8, 50% is 4. Now students, whenever there is an absolute number, students, is not accepted. You don't accept the absolute number, students. So in that case, what happens is that you will then have to do the average. Had it been 3 point something, 2 point something, then you fall to the next number. But if the statistics gives you an absolute number, full number, no decimal, then in that situation, students, whatever is the price at that number and the price at next number, you will take the average of it. You take the average of it. And by virtue of this one, students, you will be getting in this regard, students, by virtue of this, so price at this and the price of that. So what is the average? 9950. Average of these two, students, 9950, the average of these two. Now accordingly, you will do the transfer pricing adjustment. How much it would be? 2950. So how come 750? At what price, students, you have sold? Sorry. 9,200 per unit, students. Previous. You have sold at rupees 9,200. Even in that case, 9,200, students, even in that particular case, your price was 9,200. Not falling within the range. And because it was not falling within the range, accordingly, students, whether the transfer pricing adjustment is required to be done, and the answer is yes. 750, yes, 750 it would be. So therefore in this case, therefore, students, in this particular case, this is how things has to be looked upon. So 750, students, is what has to be looked upon in this particular context. Fine. So 750 into the number of unit. How many is the number of units, students? The number of unit that you can see is 7,000 unit. So 750 per unit into how many units, students? In this context, 9,000 units, 7,000 units. So therefore, whatever is your total income, which is 9 lakhs, whatever is the total income, which is 9 lakhs, on this 9 lakhs, you will add 52,50,000 rupees, being the transfer pricing adjustment. And therefore, after the transfer pricing adjustment, students, you have 61,50,000. Now, the next particular case, students, is about the arithmetic mean. The next question is about the arithmetic mean, students. Very quickly, I will run through this particular question. Here, students, what happens is that if the comparable size, as I have told you, if it is less than 6, and more importantly, you are not following the profit split method. Because students, if you are following the profit split method, then you don't see in that case the comparable size. Then in that case you don't see the comparable size, because in the comparable size, in the case of a profit split method, you always follow the arithmetic mean. This is the only particular exception to our discussion, where if the most appropriate method to determine the ALP happens to be the profit split method, then you will not see the comparable size. Directly what you are going to do, you will take up the arithmetic mean. Okay, so that is what one very unique thing about profit split method is, that you don't see the comparable size. Directly you will do the arithmetic mean in this case. The next particular question 450, which you can see it over here. Question number 450, students. In this context, here the most appropriate method, students, is the cup method. So the cup method over here is the most appropriate method. That is point number 1. And the second one, students, is in this case is that, so cup method is the most appropriate method. That is the point that you should keep in mind. And the second and more importantly is that the comparable size is less than 6. So if the comparable size is less than 6, then you will apply the most appropriate method to all the comparables, and whatever is the ALP that is determined, of those ALP you will take up the arithmetic mean. Whatever is the ALP that is determined, of those ALP, you will take up the arithmetic mean, and that exactly what you will do. I hope that all of you are clear with this one. Now again, students, just keep in mind, the comparable uncontrolled price method is what? Comparable uncontrolled price method, students, is what? Students, is done in this case. So you will have you have to take the average, students. So you'll ignore the last year, students. You'll ignore the last year data completely, and the current year data only, students. The current year data only, students. You will use it, and accordingly you will make the average. Students, just run through the solution quickly. All of you. All of you students through this one. Yeah, Prem, the 3% part only I just wanted to explain. So students, over here if you all will see, what is that you will get it over here, students. So 3% of the transfer price is what, students, you are having it over here, isn't it? Now see the computation of in this case. So what happens is that, what is the concept of 3%? So concept of 3% is that, students, in the arithmetic mean will be compared with the transfer price. the arithmetic mean will be compared with the transfer price, and the difference between the two, the difference between arithmetic mean and the transfer price. So the difference between the two, if the difference exceed 3% of the transfer price, students, if the difference exceed 3% of the transfer price, in that particular case, your transfer price will be rejected, and your ALP the ALP, which is the arithmetic mean, is what will be considered for the purpose of determination of for the purpose of the transfer pricing adjustment. But if the difference between the arithmetic mean and the transfer price does not exceed 3% of the transfer price, if the difference does not exceed 3% of the transfer price, in that particular case, students, what we will say? We will say that we will then ignore the arithmetic mean, which means that the transfer price will be accepted. No transfer pricing adjustment will be required in this regard. Is that clear to all of you? So if you see over here, the arithmetic mean is 10,305. Your transfer price is 9,700. So the difference is 605. Now 605 to 9,700. In this case, the percentage, if you see, students, no, it is 3% of the transfer price, you will see. So the percentage you will see in this case, students, is it more than 3% in this context? And the answer is yes. It is more than 3% of the transfer price. So if you see herein, the percentage between 605 to 9,700, it is more than 3% of the transfer price. And because it is more than 3% of the transfer price, the difference divided by the transfer price is more than 3%. Therefore, we will reject this transfer price, and the ALP of 10,305 is what will be considered. The ALP of 10,305 is what will be considered. Is that clear to all of you, students? Every one of you are clear with this? Any doubt whatsoever? Please let me know, students. Now, students, this question, you just mark it to be one of the important questions in this context. In the ICI module, 2 new questions was being framed on transfer pricing. In the ICI module, 2 new questions were being there. One new question has been targeted in May 22 attempt. This is the another question, which is the new question which is introduced in the ICI module, which I've captured in my compiler. So this question could be a likely question for your examination. You have to be careful about that. So this question 451, is for the computation of the ALP by applying the resale price method. Now, students, resale price method, students, if you will see over here, let me quickly first explain you this method, and then we'll look into this question. Now, very quickly, students, please understand what happens in the case of a resale price method. So, supposingly, here you have purchased, the Indian A is purchasing the goods from the non-resident A. So, there is a non-resident A which is supplying the goods to the Indian A. And that goods is resold to unrelated party. So the challenge is on this supply. This is your international transaction. Student, this is your international transaction. That is the transaction between the A. And in this international transaction, the transfer price is charged. In this international transaction, students, the transfer price has been charged. Okay. Now, what happens thereafter in this context? Thereafter, students, you will find that in this context, students, thereafter, students, there is a case for unrelated party, which is providing the similar particular goods or services. Okay, so similar goods primarily is being supplied to unrelated party. So it's a comparable transaction. And that is the goods which has been resold. That is the good, students, which has been resold. Resold to whom? Obviously to an unrelated party only. So the resale that has taken place, students, is to the unrelated party. Is that clear to all of you, students? The resale that has taken place is to the unrelated party. Fine, students. Now, in this regard, students, what happens? The resale that has taken place, students, is to the unrelated party, students. Okay. So what is the step that is involved, students? The step that is involved is that the first step. The first step, students, is to calculate or determine the gross margin percentage in the unrelated party transaction. Calculate or determine the gross margin percentage, students, in the unrelated party transaction. That is the first and the foremost step that you have to do. Okay. Generally, it is given to you in the question, but if supposingly they have not given to you, you can also calculate that there is a resale price of that unrelated party compared with the purchase price. So that will give you the gross margin. Okay. Now, after that, students, what you will do in this case, the step 2 that you have to do, students, herein is minus the gross margin percentage, students. You will have to reduce the gross margin percentage above. Students, you will have to reduce the gross margin percentage above, students. Okay, so whatever is the gross margin percentage determined in step number 1, that will be reduced. Once that has been there, friends, you will arrive at this stage because the gross margin is of the uncomparable transaction. If that is reduced, you will come at this stage. At this stage, students, step 3. Here you will do whatever the price which you have determined. So what you are going to write here? The price determined after step 2. After step 2 shall be what? Shall be subject to adjustment. Shall be subject to adjustment relating to the uncommon factor. So the price that you will determine, students, after step number 2 shall be subject to the adjustment which is relating to the uncommon factor, students. So just like in the case of the cup method, as you all are aware, in cup method what we do? We do the adjustment of the uncommon factor, isn't it? So the same thing you will have to do it over here. So students, whenever you have to do the adjustment of the uncommon factor, please pay attention here. You will ensure that whatever are the factors, whatever is the price that is determined, that price needs to align with the factors which are there in the international transaction. That is the A transaction. Always keep this particular point in mind, students. The price that you determine, students, that particular price will be adjusted. That particular price, students, will be adjusted with what? The adjustment would be in respect of the uncommon factor relating to the adjustment related all the uncommon factor in such a way that the price so determined gets aligned with the factors which are there in the international transaction. So that is how always you should keep in mind whenever we are doing transfer pricing adjustment. In those particular adjustment, we should be aligning this particular price in such a way, or doing the adjustment in such a way that it gets aligned to the factors which are there in the A transaction. That we'll see in this question also. And once you have done, price determined after step 2 shall be subject to adjustment relating to uncommon factor. After that, you'll get the ALP. So after step 3, so step 3 will give you the ALP. And once you get the ALP, students, accordingly thereafter, as you all are aware, do the comparison. The comparison between at what price you should have purchased the goods, which is your ALP, and at what price you have actually purchased the goods from your non-resident AE, which is your transfer price. So do the comparison, and the difference, students, is what will be the transfer pricing adjustment. On that note, students, let's see this particular question then. Earth Private Limited, Calcutta, is engaged in trading of electronic goods. It purchased goods from its associated enterprise Sun Pte Limited, Singapore, and also from its unrelated party. So it has purchased goods from, students, from these persons. From its associated enterprise Sun Pte Limited, Singapore, and also from its unrelated party, Ocean Limited. So Sun is the associated enterprise of Earth. Ocean is unrelated party of Earth. For the financial year 21-22, the gross profit margin was 15% on the sale of goods of Sun Pte, whereas it was 20% in the case of Oceana Limited. Now you tell me, students, step number 1, we take up the gross margin of the unrelated party transaction. We take up the gross margin of the unrelated party transaction, and the unrelated in this example is Oceana, not the Sun. So what is the percentage which would be considered? 20%. And this 20% is what would be reduced in step number 2 against the reselling price of the goods which Earth has purchased from Sun. So this is Sun, this is Earth. So the goods which is purchased by Earth from Sun, the price at which it is resold, from that particular price you will reduce 20%. You will reduce 20%. Let's have a look. Here, students, just I'll take you through this one. So just see this one, students. During the financial year 21-22, it sold goods of Sun Pte for rupees 20 crores and of Oceana 15 crores. So Sun goods are resold at what price, students? 20 crores. So this is what? So Sun 20 crores is what we'll consider. And from 20 crores we'll minus 20%, which will give us, after step 2, I'm getting 16 crores. After step 2, I'm getting 16 crores. Isn't it? And now from that 16 crores, I will do the adjustment relating to the uncommon factor between the two transactions in such a way that whatever is the price that will arrive after the adjustment, that particular price will align to the factors. That particular price, students, will align to the factor which are there in the A transaction. So now 16 crores is the price, but that is without adjustment of the uncommon factor. Now we will have to do the adjustment of the uncommon factor after that, and that adjustment would be done in such a way that this resultant price, whatever I get after adjustment, this should align with the factors which are there in the international transaction, and that is what would be my ALP. That is what would be my ALP. So let me look into this one, students. What are the uncommon factors which they are mentioning it over here? So students, this paragraph is all about uncommon factor. Please read this one. This paragraph is all about uncommon factor. Students, the next class, students, is at, I hope that you all are aware, 2:55 p.m. We will be continuing transfer pricing. And today, I suppose, then there is one lecture in the evening also. That I think is at 5:20 p.m. or something. So by today, your transfer pricing would be through. Tomorrow, then assessment procedure will get started. And I'll be through with your assessment procedure also tomorrow. And then I'll start with the PGBP thereafter. So this is what the things would be there. And you will find that very quickly we will be done with your compiler series also, students. Congratulations. So students, please go through this one. Through with this one, students. So what they are saying, just read that paragraph. The after sales warranty of 6 months was provided by Sun PET Limited, whereas Oceana Limited gave after sales warranty of 1 year. So Sun is providing for see, warranty should warranty, if it is in the price will increase. Come warranty price, students. Both of them are come warranty price. Unrelated party also and international transaction also. Both of them are at come warranty price. The only difference is that the unrelated party transaction come warranty is for 1 year. Whereas for the related party, the come warranty is for 6 months. For the related party, the come warranty is for 6 months. This is the difference, students. And therefore, students, what I need to do? I need to then, from the price which I've arrived, what is the price? 16 crores. From that price, students, I will ensure to make it at 6 months, because presently it is at 1 year. So since it is at 1 year, thereafter I will bring it down to 6 months. And how do I need to do that, students? I think all of you are aware. So the cost of warranty has been given to you. 2% of selling price. What is the selling price over here? 20 crores. So 2% of selling price of 20 crores, which is 4 crores. Isn't it? Now this is for 1 year. This is for 1 year. Then how much for 6 months, students? For 6 months, then in that case it will be 2 crores. So I am going to reduce 2 crores, students, in this case. Yes, Prem. So this is for 1 year. For 6 months it will be 2 crores. So 2 crores I have to reduce from this 16 crores price in respect of the warranty factor. In respect of the warranty factor, this 2 crores will be reduced. After that, students, if you see, during the financial year 21-22, it sold goods of Sun PET Limited for 20 crores. For 20 crores, students. So can you see this one? So this is for 20 crores, students. So in that particular case, For 20 crores it is. And accordingly, students, what is that situation? Sorry. 20 lakhs. 2% is 20 lakhs. Students, herein, in this case, as regard transportation cost of the goods purchased, there was no difference between... just go over. Students, Sun PT brand value is internationally known and the benefit of brand value was taken at 1% of selling price. The benefit of brand value was taken at... So the brand is there. Students, in the case of international transaction, it is with brand. Unrelated parties without brand. Brand will increase the price. Isn't it? As compared to unbranded, the branded will always be on a higher side. So therefore, this I have to make it branded. The price which I have got of 16 crores, which is unbranded, that I need to make it branded. And how do I do that, friends? In that case, I will add what? 1% of selling price. So 1% of selling price would be how much, friends? 20 lakhs. So effectively, students, I add how much? I add 20 lakhs and I'm reducing 20 lakhs. So it's actually one and the same. Doesn't make any difference. So this is what it is, friends. Now can you just go through the solution? So can you see? I'm adding here 20 lakhs and I'm reducing 20 lakhs. So effectively my arm's length price would be 16 crores. Effectively my arm's length price would be 16 crores. I hope that all of you are clear with this one. Fine, students. With that, students, we are done with this. Students, now I'll meet you at 2:55 afternoon. We'll proceed further in our transfer pricing session. Now, students, important announcement which I'll just do with all of you. Hear it. Important announcement, students. And the important announcement, students, is in respect of, can you see that, students? The Unacademy subscription plan. 20% off would be there for 20% off would be there. Prem, can you ask me in that 2:55 class? It will be better. I just have one more lecture. So if in 2:55. Do ask me in 2:55. I'll answer you. So students, here between 27th to 30th of June, 20% off on all the CA subscription, meaning thereby whether it is CA Foundation, Intermediate or CA Final. You have got a full CA curriculum which is covered and 20% discount is what will be given, students. Only one thing you need to do, students. And what is that one thing, students? You need to put the referral code CADS. That is the only one thing that you have to do. So students, please, those who have got their attempt in November 22, May 23, November 23, May 24, you may have got your friends, colleagues, juniors, relatives. Please do let them know about this scheme because this is only till tomorrow, actually, till 30th. And tell them that the referral code that they have to put is CADS so as to get that 20% discount. Okay. So students, just let them know. And students, I'll ask you, I'll be meeting you at 2:55 now. Prem, please put that query in the 2:55 class. I'll answer that at that time. Okay. See you at 2:55 then. Thank you, students. Take care. Bye-bye.